market. Today we have a very special guest with us, Mr. Ajay Marwaha. He is the head treasury of Sun Global Investments. Welcome to the show, sir.
Thank you.
Sir, we would like to know what's your view. How do you see the FPIs, coming back to India as a good investment opportunity in 2019?
I think the important thing is when you talk about a new year, there are new allocations. And typically, whenever you have new allocations in a new year, all markets are studied in terms of prospective returns, risks, etc. I think one of the key issues that we face as a country today is that we have an event called the elections, which is looming, right? May, whatever it may be, April, May. And the outcome of those elections has become slightly more uncertain than would normally be, given the results of the state elections in December. Given that background, obviously, any investor, whether it's local or foreign, will start re-evaluating the risks into investing in India. However, if you would drill down to the granularity of that, some of those risks actually may end up becoming bond positive.
Okay.
The key risk is if policies, etc., are not continued to be within the framework that's been developed by this current government and worked on, then you could see a little bit of a slowdown. India as an economy, typically the 6% handle for growth is a very standard kind of assumption. That engine runs at that pace, right? It is when you start trying to extrapolate the 7 or mid 7s or early 8 handles that the economy needs additional traction through various governmental measures. And that's where things like the elections, things like the next government and its focus become important. The issue that I see here is whereas the BJP has a certain economic agenda, it's been out there, the opposition, most of the discussion as far as the opposition is concerned is the coming together of forces opposing the BJP. There is no policy agenda that I have read. In the absence of that policy agenda, the fear we have is obviously a growth slowdown.
Correct.
But a growth slowdown, given the backdrop of the current inflation scenario, is actually not a very bad thing for the bond market.
Right.
It's a terrible thing for the equity market.
Right.
And therefore, overall, I think you will see FPI interest from a fixed income and credit perspective to be reasonable into India. Where there is a word of caution is that what seems to have happened across emerging markets, not necessarily India itself, is spreads have tended to start to widen.
Okay.
Investors, particularly into EM, and we've seen this happen time and again whenever US rates tend to be rising and there is a flow of money from EM into G3.
But recently we have seen, that the hike cycle which was there in US has almost come to an end now.
Well, yes, I mean the dot plot is not looking as aggressive as it was.
Right.
Having said that, but you're coming on the backdrop of rates moving up 200 basis points, right? So you have to evaluate things with that perspective. Okay. Given that situation, what happens to emerging market flows is they become more discerning. Okay. They become more risk aware. And, honestly, if things start to go wrong, then that risk awareness can translate into risk averseness very easily. Okay. So that is the flip side to flows into that. So my own sense is, whereas flows into the sovereign within a reasonable band of levels will continue, I don't think there is bullishness about India rates rallying below 7.25 on the 10-year bond. I mean, those are kind of thresholds where international investors start feeling uncomfortable from a sustainability perspective. Okay. Opportunistically, people will come and go. But sustainably, from an investment perspective, that becomes a challenge. Okay. Whereas I think at this point in time, given the inflation scenario and hoping for a reasonable monsoon, levels closer to 7.75 to 8% and above seem to be fairly attractive for investors to come in. So overall, I think the investment scenario from an FPI perspective into India will remain reasonable. Okay. I don't think it looks as great as it did in 2017 or 2018, but it remains reasonable. I think the important thing at this point in time is to kind of focus more on spreads, on credit spreads, and I think that's where some value can be had because those spreads are far wider than they used to be.
Okay.
I think the significant point is there has been some selling, and clearly there's been a significant amount of selling when we saw the risk off kind of EM risk off take place. Now that in my view was a standard event where we saw a lot of these EM portfolios shifting to G3 portfolios. When you see that happening, there's going to be proportionate amount of disinvestment. Right? Also, the more liquid markets and markets which have been more profitable to own will be sold first because you're realizing gains. Unfortunately, from an India perspective in that context, India as a market has only been minus 3% or so this year in dollar terms. Some of the other markets have suffered much more.
Much more, right.
So when a portfolio manager who's managing EM wants to lighten his portfolio, he would rather sell something that is only 3% negative than sell something, a part of his portfolio which has lost 10 or 20%.
Right.
So that is contextual to some of the actions that may have taken place. I would assign very low importance to the fact that this selling has India negative connotations. I don't think it does. I think India remains a very healthy market. I think there's a lot of confidence in this current government. I think some of the actions of the government have been extremely positive. There have been questions about the implementations of certain measures. But look, in a country as diverse and large as India, those questions will always remain. So it's nice to be skeptical. It makes media headlines. But I think the steady state approach is to look at some of the positives that are happening. There's been an overall improvement in the country's macro, whether you look at FX, whether you look at our kind of overseas dependence, whether you look at the domestic banking system cleanup. These are all structurally important and measures in the right direction. Yes, they've caused some, there has been some strife, right? The quasi-sovereign banking system is a clear collateral damage that's been caused. But to get things cleaned up, which have been dirty over 20 years, there is going to be some strife. So you've got to take it, with that pinch of salt. So overall, I don't think there is a negative sentiment RE India at all. I think, however, the emerging markets are clearly at this point in a state of question as far as investors are concerned.
So can we say that, India is still one of a very good, fundamentally looked at as an investment avenue by FPIs?
Definitely.
Okay. So coming to, talking about one of asset class, as you rightly mentioned, corporate bonds is one of a very good avenue where FPIs look into, because last year we were seeing that, FPIs were fighting to get that percent of a limit.
Correct.
So this year we have seen that, drastically falling.
Yep.
Can we see that reversal coming in? Are the FPIs, looking at corporate bonds as a good avenue, or are there certain measures like, recently announced norms which are there restricting these FPIs from, being in one particular portfolio for say 50% of the holding or 20%, and in the residual maturities of less than 1 year for just 10% of their own whole portfolio.
Yeah.
So how are these measures, to be looked at by FPIs?
So let me break up that question into two parts, right? I think the first part of the question is, yes, there was a lot of buying into Indian corporate paper. A lot of that was driven by carry, but remember that a lot of that carry had nothing to do with the underlying credit. It had a lot to do with the underlying currency.
Right.
The Indian rupee remained stable for almost 4 years in a very tight range,
right.
If anything, an appreciative range. That was supported, that whole behavior was supported by low oil prices, and therefore our external account looking healthier than it normally should. And anybody who read medium term into that would have understood that that's a temporary phenomenon, that aspect of our external account. I think the other point is that at that point in time, you also had supportive FDI and FPI flows. So it's kind of a virtuous cycle,
correct.
Which kept the currency where it is. Now, when you have a currency which stays in a narrow band, which is appreciative, any kind of investment into a high inflation, high growth kind of economy like India affords a very reasonable carry. And it is that carry that drove a lot of those flows in.
Right.
So that's the perspective on those limits getting full and all of the things that we saw in 2015-16. That situation has reversed. There are multiple reasons for it. The external account looks very different today. Oil prices look very different today to start with. There are other important factors to the external account. The whole, I think the one big failure or let's say disconnect between some of the noise we've heard and some of the actual action on the ground has been this make in India kind of noise, right? There is no make in India, right? What has happened is demonetization and easy money policies actually led to a lot of that consumption being driven towards import. And the import cycle picked up. When you have a situation where your import cycle picks up, oil prices are high, you're clearly going to have a run on the currency, which is what we saw.
Correct.
Thankfully, over the period of the previous 4 years, a very smart central bank had accumulated a healthy bunch of reserves. So we had the ability to curb that volatility to some degree. But having said that, this currency volatility will to some extent defeat the carry intent behind these flows. So a reversal is natural, and we saw some of that. I think when it comes to looking at measures on the other side, yes, some of the measures have been hard to understand, whereas one is completely sympathetic with the monetary policist approach to some of these measures and the fear that you have a lot of external flows which may start dictating domestic monetary policy, and therefore the Reserve Bank has to be on the guard. But what I struggle to understand from time to time is the quantum of these flows, the size of overseas interest into Indian credit and Indian fixed income is so small that this fear seems to be exaggerated. And some of these measures, therefore, as a reaction to that fear, appear to have draconian connotations. For a foreign investor, it's even more so, because when he looks at a regulatory framework in a country which is kind of prohibiting that investor from carrying a certain percentage of portfolio in a certain duration bucket, it's very hard to understand. Also, I think one very important thing is when you have foreign funds which invest into countries, they come in with the assumption that they can buy and they can sell.
Okay.
That's a decision of the portfolio manager.
Right.
That's the way funds are created, packaged and sold. Here you have a situation now, of course managers know it today, but now we have a situation where portfolio managers from 3 years ago who built portfolios into India have had superimposed these norms.
Oh.
So suddenly some of their behavior is dictated more by regulation than market view.
Correct.
That in my view is completely not on. You have to have a situation where fund managers, if you open a market, should be allowed to buy and sell freely.
Right.
Regulatory kind of constraints cannot be imposed on what they buy and what they sell. If we are so concerned that these funds will come and create a destabilizing environment for domestic monetary policy, please stop them from coming in. But in my view, obviously, I mean, that's stupid. This is a time when, look, India opened up its equity capital markets 25 years ago, right? Capital is the base on which you have to build growth.
Right.
But growth is driven through financial leverage. That comes from debt. And in my humble opinion, going back to these basics, India today is at a stage where we need to borrow to grow.
Definitely.
We have to open every conduit of borrowing that we can. Any kind of constraint you impose on these kinds of borrowing conduits is a self-defeating exercise.
Okay.
So, whereas I completely respect the policy approach, I completely respect the monetary approach, but at the same time, contextually, some of these regulations are not in sync with the needs of the country.
So that means you are saying that, the policies, certain regulations are trying to restrict the flows,
Absolutely.
correct? So let me, get a little bit more details from you on this. Recently, we have heard that, the Central Bank of India is planning to meet the foreign investors to, know their side of view and probably what exactly are the problems which they are facing, and what probably can they do. So there were, sounds from the market coming in, talks about, the RBI or maybe India is, letting them invest in certain respective restricted manner. So do you see foreign investors to, asking for certain this deregularized or maybe certain less number of restrictions to be there, or what exactly are the foreign investors expecting from RBI?
So I read this news wire, right? Report saying there may be this interaction between FPIs,
Correct.
foreign investors, and the Indian regulator.
Right.
I found it fairly humorous. By definition, foreign investors are foreign.
Right.
They don't live in India.
Correct.
Right? I haven't seen an invite go out to foreign investors outside India to fly down to India for these meetings. So I think the context of that news wire was incorrect, in my humble opinion.
Okay.
I think what clearly the central bank and all regulators would like to understand, and I think that's brilliant, is what is the perspective
Right.
of foreign investors. But I think these interactions, the way they will be conducted, will be through the custodians domestically.
Correct. It is, they are meeting the foreign banks.
Yeah. Foreign banks are not foreign investors.
Right.
Let's be clear.
Yeah.
Foreign banks, if anything, may be limited conduits to foreign investors coming in as custodians. With due respect to the custodian business is not a markets business, right? It's a process business.
Right.
Who is getting impacted with these measures? It's investors. It's
Right.
traders, portfolio managers. They don't sit here,
Correct.
right? Some of them sit in Singapore, Hong Kong, New York, Dubai, wherever,
Right.
London. And at the moment, there is no forum where these investors voice their opinions which can be heard by the Indian regulatory mechanism, right? Is that a lacuna? Maybe. Does it exist in other markets? Not necessarily, right? Is it relevant for India? Of course it's relevant for India.
Right.
The reason it's relevant for India is because someone like myself who's been involved in the domestic capital markets for 20 years, my view is that you have to reach out for capital. Debt
Right.
capital, particularly. If you want to reach out, then you have to enable those doors, those corridors
Correct.
to work. To enable those corridors to work, you can't take business as usual situations, right? This is something you want to do as a country. So go out of your way and create these dialogues. By meeting a custodian, you will not get
The exact perspective
Exactly.
of the foreign investor.
exactly.
Right.
So that's one side of the story.
Thank you so much, sir. It was an amazing session with you. Would love to have similar other sessions if we get some time.
Sure.
It was great having you here.
Thanks for getting me here. Thank you.
Thank you for watching Ticker Market.